Chandler. I'm with AMC Mortgage, and so we are actually upstairs in this office. We've been working with Berkshire Hathaway for several different, well, actually many years, with a few different company names, but I've taught several classes with Larry. My mentor, who I learned everything about financing, taught classes with Larry for years and years and years. So I'm excited to be here. I know that numbers and the financing side of things can be sometimes kind of dull, sometimes kind of dry, but I like to make this more of an interactive class. So if you guys have questions, as we're going throughout the morning, just raise your hand, let me know. I want to make sure that y'all understand everything, the best that you'll need to. The main thing to take from this class is you don't have to know everything that I know. Obviously, I'm the mortgage person, y'all are the real estate agents. But if you ever have questions, the main thing I want you to know is my cell phone number. So I put that in the folders for you guys, and I'm going to kind of use this as our template throughout the morning. We'll just kind of go through this folder, touch a little bit about the purchase contracts and how to write the different financing supplements for an FHA transaction, a VA transaction, a conventional financing transaction. Give you guys some cheat sheets and things to know about the different types of financing, and really just give you a general understanding of financing that you would need to know as a realtor. So
Turn
again,
your ringers off. I'm sorry.
No, you're fine.
Here you go.
Yeah. So I guess just to start, I'll tell you a little bit about myself, our company. You'll see that you have two cards in your folder. So I work on a true team. Kathy Rodarm is my partner, and we're both here upstairs. So I wanted to give y'all both of our contact information. And I would say if you want to go ahead and save it in your cell phones, sometime throughout the day. And if you want to send me a text message so I have all of y'all's contact information, Kathy and I will save it in our phone. We know that y'all are oftentimes working nights, working weekends, and we have no problem answering the phone, talking for 10, 15 minutes, try to get, a customer questions answered so that maybe y'all can write up a contract and get everything squared away, say on Monday or the next day. So don't hesitate to call. Some people don't want to take, calls after hours, but we know that's when y'all are working, so we're perfectly fine with that. AMC, so we are a full-service mortgage company. We're not a bank and we're not a broker. What that means is the entire mortgage process is done here locally. And again, we sit upstairs. So Kathy and I are the originators. So we talk with the clients, figure out what type of financing makes most sense for them and their family, gather all their documentation. The processing is done here locally, and my processor sits 10 feet away from me. Our underwriting is done locally. She's also about 10 feet away from me. We have local closing. So the entire process is done locally. We don't ship their information off to a different state or region to be worked on. So if anybody has questions, or if you guys have questions about a client that you're working with and kind of how their financing is going, call Kathy or me and say, hey, where are we at? What do we need? You don't get pushed off to some stranger. We're also approved by all government entities for financing. So we're going to talk, we're going to hit probably the most, we'll talk more about the four most common types of financing. We take care of FHA, conventional, VA financing. We do a lot of down payment assistance, and we'll go over that as well. HUD 184 Native American loans, rural development loans. We do renovation loans as well. So if you're working with a client who wants to buy a house, but it's a fixer-upper, and they want to redo the kitchen, move a wall, redo the bathrooms, things like that, we can structure their financing to purchase the home and include all those renovations as well. So we take care of all the different types of financing. I got a few copies of some flyers. I think the first three things, a lot of it's more so for a client, but if you guys ever want us to make more copies of this that you can hand out to people you're working with, in color, we're more than happy to do that. But just wanted to give you a little bit of information again about our company. The second flyer again is more so for your first-time home buyers, to let them know, what are some things that I should do, and how does the flow of purchasing a home look like over the next, 30, 45 or so days. So people who have not been through the process before, this is just a good, kind of checklist or, general schedule of what their transaction would look like. And then the last one, again, talks a little bit more about the loan process. So what does pre-qualification mean? What are we doing in processing? What are we doing in underwriting and things like that? So just kind of informative for you guys as well, but also for your clients. One thing I think that we could do is I'll start on the right side of your packet, and we could spend a little bit of time just going over the contract. So I'm going to teach mostly the financing aspects of the contract. Larry's going to go over, in more depth, much more than I'll speak about, but I just want to go over the things that are most important to me as a lender for you guys to know whenever you're going through a contract. So I've filled in most of this. If you have any, want to make any notes, I'd go ahead and make it on this contract. So as you're studying this and the first few times whenever you're walking a client through writing a contract, you can just use this as a reference. So you'll know, exactly how to kind of fill everything out and what information might be needed. So just kind of starting at the top on the first page, at the very top, you'll notice that there's several different checks, boxes to be checked. Those are all needed. All that information would need to be included whenever you submit your contract to your lender. So on the left side, this is going to let us know what type of loan you're doing. And it also gives you a reminder that you would need that financing supplement to be attached to this contract. And I've included each of those sample financing supplements, but if you're doing a conventional loan, you have a conventional financing supplement. FHA has its own financing supplement. VA has its own financing supplement. If there is seller financing, you could check that, and the seller would be carrying the note for the buyer instead of like a bank or a mortgage company. On the right side, this lets us know, if there is an HOA or a PUD, planned unit development. So if there would be a separate attachment, for an HOA. If there's a condo association or a townhouse, this just lets you know, hey, if these things apply, I need an additional sheet of paper to turn into this contract, to my lender and to the title company. And then at the bottom right, you'll see sale of buyer's property, if it's under contract or if it's not under contract. That's going to be a pretty important thing. We'll discuss this with your clients, but you'll also want to discuss this with them if they have a house that they live in now and them buying a new home is contingent upon the sale of that home. That's very important to know, because if this home doesn't sell, you can't buy this home. Typically for one of two different reasons. You're taking net equity from your current home to put as a down payment on the new home. So one reason why that's important is there's your cash to purchase the new home, okay, or your down payment. The other reason is if your home doesn't sell prior to purchasing the new home, we would have to qualify you with both house payments. Some people, that's perfectly fine. They can buy a new home without the sale of their home if they have plenty of assets, and we can qualify them with both payments. Not everybody can, so that's just an important conversation for you guys to have up front with your customer. Hey, do you need to sell this home? Where are your assets coming from to purchase this home, and can you qualify with both payments? If they can, that makes things a little bit easier, but if not, that's something that we all need to go through. Okay, so as far as the parties and the contract is entered between, it's easiest for you guys to just write how the sellers are currently taking title. Every once in a while, you'll have someone, a realtor might just list owner of record. Just don't do that. Just ask them, hey, how do you currently take title? Or if they don't know, a lot of times you can just go to the county assessor's website to see how title is taken. But that's how we're going to fill this out, how title is currently taken, and then how the buyer will take title on the second page. So a lot of times you might have someone's legal name, but they go by a nickname. Let's put their legal name for how they're going to be taking title to this property. All that's kind of self-explanatory, but it is convenient. About middle of the page, again, this is pretty easy stuff. Just the county that the home is in. As far as the legal description, you guys might not know that information. It's available on the county assessor's website, but it's not really important that you have the legal description whenever you submit this. Title companies can get that information for us. But you do want to fill in the address, the city, and the zip code, and then also the county. That way, whenever we submit our title request to work up this transaction, all our information is correct. The contract matches what we're putting on our loan. what the title company is going to have, what the appraiser is going to put on his report. So we want everything to be the same. Okay, this is pretty important. So this is a cash transaction unless a financing supplement is attached. So again, if we don't have any check marks up at the top, that's telling everybody they're paying cash for this home. So we'll catch this if just say, hey, where's your financing supplement? But again, just a reminder for you guys to fill out that information. As far as earnest money, well, obviously you'll list the purchase price of the home. You'll list the amount of earnest money in paragraph 2. And then right there, you'll just list the title company that you're going to be closing this transaction. Just about every Berkshire Hathaway office either has a first title company within the building or very close. So we're fortunate enough to have first title, downstairs here. They have one down south, and I believe that Midwest City has one as well. You're in Midwest City? Okay. So, and I've got some information about first title, but if you haven't met them, they're great folks to work with, and obviously it's a convenience for us and a convenience for you. If you have any questions about your title company, you can walk right next door instead of calling someone or emailing someone.
They'll be here on the 2nd.
Gotcha. Yeah. So I'll touch a little bit of their information, but they'll give you a lot more information about, what's the easiest way to explain title insurance? What does this service do? Are any of y'all familiar with title? Like title insurance or kind of what that does?
I understand it, but I've never done it.
Got you. Well, again, they'll go over that. I generally think if they can just do a good job of explaining very simply what this does so you can explain it to a buyer, then you're going to be set up for success. Again, you don't need to know all the ins and outs, but if you can just generally explain what title insurance does, it'll be a very good service for your customers. And they'll go over more of that with you guys. The bottom of this first page just kind of talks about what are some of the expenses that a buyer is responsible to pay and some of the expenses that a seller is responsible to pay in a transaction. So I went ahead and underlined some of these. So buyers shall pay buyer's closing fee, buyer's recording fee, and all other expenses required from the buyer. Sellers shall pay doc stamps, seller's closing fee, seller's recording fees, and any other expense required from seller. And then as far as funds for this transaction, so the day of closing, when you guys and your customer show up to a title company, they're going to sign all the documents and actually purchase their home. This contract says that you can bring cash, don't bring cash. I mean, obviously, if it's a cash don't bring cash. We always tell our customers, bring a cashier's check or wire funds to the title company. So I just want to drill that in y'all's brains. Yes, sir.
It's been a while since I've taken the test and stuff. I haven't really been hitting on it, but what are the doc fees? I kind of forgot about the doc fees.
Like, what are they, or like how much are they?
What are they?
So the doc fees, there's a couple different fees, and we'll go over that. I have a fee sheet that kind of states what are the fees for a transaction, about how much they are, and what they actually are. So we'll get over, we'll go over that in just a minute.
Well, two-part question. Like, you're with your buyer. They're going to want to know what these fees and things are, but you said they got to have, like, say, a cashier's check for closing.
Mm-hmm.
So they will know an exact amount to take to closing.
Correct. Yes. So one of the things that we provide as a lender and something that you'll provide as a realtor is you guys, give your buyer a cost estimate. Mm-hmm. Here's how much I'm estimating that you're going to need to purchase this home. And we do the same as well. Before they're ever under contract and they say, hey, I want to get pre-qualified for a home, we make them examples of financing that show, hey, based off of your credit score, here's about what an interest rate would look like for you. Here's about what your monthly payment would look like. And if we don't have an address, we just estimate taxes and insurance. So we'll know roughly, here's about what your monthly payment would look like. Here's all the closing costs that you'll have. Here's about how much you need to purchase this home. So once they are under contract, they'll get an insurance quote. We'll pull the property taxes from the assessor website. So we can pretty much pin down a payment. As far as all the closing costs and prepaids for the transaction, the title company will finalize all those, to get exactly what's the cost of their pest inspection. All their abstracting, from title company to title company. But several days before closing, they will receive a final closing disclosure that has all of their costs for the transaction itemized. And it's the final number that says, yes, you can go to your bank, you can request your wire transfer or get your cashier's check for this amount. So yes, so several days before closing, they will know that exact number, but well before, whenever they start this whole process, they'll have an approximate amount. And it could change, if additional inspections are needed, things like that. But they do have that final number in advance of closing. It's a good question. But yeah, the most important thing, we tell them, it's always better for a buyer if they hear the same information more than once. So we say cashier's check or wire transfer.
But they can't write a check.
They wouldn't write a personal check.
Okay.
Correct. That's why we say cashier's check or wire transfer.
Okay.
There have been people that show up with a bag full of cash at a title company, and that doesn't work. And the reason why we do cashier's check or wire transfer, from a financing point, back after 9/11, the U.S. Patriot Act went into effect. So any mortgage company, bank, financial institution, we're required to follow the money, for transactions like this to avoid, money laundering, funding of terrorism, things like that. So there's no way for us to source cash or to know where it came from. And you can't use cash to buy a house. Mattress money doesn't work. It doesn't work, and we'll go over that a little bit later. But we have this conversation with people. Again, I'm always a proponent. If they hear the same information from you and from me, they're going to feel better that it's valid information. But mattress money, cash, it doesn't work. Okay, personal checks, those don't work either. So cashier's check or a wire, from their bank, those are how they're going to get this money or bring their funds the day of closing to purchase their house. Okay. So the next page, the top of this just goes over things that if they are on the home, it says the following items, if existing on the property, unless otherwise included, shall remain with the property at no additional cost to buyer. So these are your normal things that a normal buyer or seller would expect to be kept with the property. If for whatever reason you are not going to include if the seller is going to take these things with them, then they would need to list that in, paragraph B, exclusions. So I'm going to take my ceiling fans with me. Most people would expect your fan's going to stay with the house. So if it's not, you would list that in paragraph B, under exclusions. But this is one thing that you guys, over time, the more homes that you sell or the more homes that you help someone purchase, you'll get questions about this. Hey, can I leave the washer, and dryer? Can I leave the refrigerator? As far as appliances or general inclusions, those are perfectly fine. So if y'all want to make a little note under, A, refrigerator, washer, and dryer are perfectly fine. Those are customary to leave with the home. But, if you have big screen TV in the media room, things like that are not fixed to the house, like if it's a projector and you have mounted speakers and mounted receivers and things like that, again, you'll see TV antennas, satellite dishes, and whatnot that are fixed to the home. Those can stay. But if you just have a big screen TV that someone wants to throw in to make this a good deal for the buyer, Fannie Mae, FHA, VA, they don't finance TVs. They don't finance your sofas and your comfy recliners and things like that. So I just want to set you guys up for success. You won't include furniture or the ride-on mower in the backyard or things like that with in your purchase contract. Sometimes it's perfectly fine to have a separate bill of sale where the seller just wants to include that, but that can't be in our purchase contract. So y'all can do a separate bill of sale for those things between your buyer and your seller, but your purchase contract, it won't have furniture, it won't have the old Corvette, in the shop and things like that. That will not be in this contract. All that kind of makes sense? Okay. As far as in paragraph 7, so investigations, inspections, and reviews. So very important thing, whenever just about every buyer is going to have a home inspection done on a property. Okay, so let's talk home inspection versus appraising. Your home inspection is going to check your appliances, your electrical, your plumbing, your foundation. They'll take a look at the roof just to say, hey, is everything working? What things are broken, need to be repaired, need to be fixed, whatnot, as far as the condition of the property. A home inspection is not required to get financing on a home, okay? But just about everybody's going to want to do it to know if there are issues with this house that they need to address, and they can negotiate those repairs with the seller of the home. So they know when they get into this house, everything's going to work, and if it's not, they know what's not working. That's home inspection. Appraisal determines the fair market value of the home. So if you're going to pay $250,000 for this home, we want to make sure it's actually worth $250,000. That the collateral for this loan is justified. Does that make sense? If you're getting financing, you do have to have an appraisal on a property. There are some instances where you don't have an appraisal, and that would be a property inspection waiver. So let's just say on a conventional loan where you have a very low loan to value. Like if you're putting 50% down on a home, you have a low loan to value, right? So on conventional loans with a low loan to value, if Fannie Mae and the internet have enough statistical information on this home to support that value, whenever we run our underwriting system, they'll say, hey, you actually don't need an appraisal. Fannie Mae is fine with this value of the home. Don't need an appraisal. At that point, they have the option. If they still want one, we can definitely order one. But I'd like to. It's a lot easier if you don't have to wait on the a week and a half to maybe 2 weeks or so to get that appraisal back. And if there might be any issues with
why would you?
Yeah, again, it doesn't happen very frequently where you have the option to not have an appraisal. But when you do get lucky and you have the option to not, just about everybody waives the appraisal. Because it's faster, it's one less thing to worry about. If there's any change in value that the appraiser might find, kind of don't need to complicate things, if everybody's fine with buying the home for that value anyway. Does that make sense? So that's kind of the one exception where you would not need an appraisal on a home. But the mortgage company would take care of ordering that appraisal. And it's kind of on a rotation basis. Each company said we have like a panel of appraisers that we work with in rotation. Some people or your customers might say, well, hey, I've got a buddy who's an appraiser. Can we not just use him for this? The reason you can't is because if you know that appraiser or they're your buddy, they could be influenced to meet that value or make it a little bit higher or whatnot. So that's kind of why individual appraisals aren't chosen for a particular property. It's on a rotation basis to kind of keep that unbiased, objective valuation to the property. Does that make sense? Okay. So everybody good on the difference between your appraisal and your home inspection?
I have a question on VA loans though.
Okay.
Don't they require it? I mean, even with whatever down.
Yes. So again, the property inspection waiver that I was talking about, where you have the option to not have an appraisal, is on conventional loans only.
Okay.
So government loans, FHA, VA, you don't have that option.
Now, do they require an inspection also, VA?
The home inspection?
Mm-hmm.
No. So,
No. Okay.
Yeah. So again, the home inspection is not required, but everybody's going to do it. And you guys as realtors should definitely encourage all your clients to do it, so they know before they, before they purchase this home, what kind of condition it's in. And go ahead.
I don't want to interrupt a bunch, but since that is a license violation,
What?
to not encourage a home inspection, they're not required for financing, but these are all new realtors.
Mm-hmm.
Because we as realtors, if we discourage anyone from getting a home inspection, we can lose our license for that.
Okay, so we should just kind of
you
try to encourage it.
You should always encourage a home inspection, whether it's required on the financing or not.
Definitely. And another,
Which is what you're saying. I just wanted to add that.
Yeah, correct. And one thing that you guys can do, and Larry might have this information, or you could get with, say, your broker or some other experienced realtors in the offices that you work at. Just get some information for several different Get information from several different home inspectors. That way you can just pass that information on to your clients. But even, I don't know about, legally or whatnot, but if the customer has that inspection, maybe mentally they might, if, let's just say they don't get an inspection and then there's all these issues that they didn't know about. I think mentally they might want to pass some of that blame onto you guys because you helped me get into this home and now I have all these issues with it and I'm going to call you 2 months after closing to try to get this fixed. Again, take yourselves out of, some of the condition of these properties with that inspection. Hey, before you closed, you had the opportunity to know everything that was working or not working with this property. So again, tell everybody to get a home inspection, but it's not required for financing. Okay, good question. So we talk about with the investigation. So that is a buyer's expense.
Well,
Okay.
the termite is, right?
The term, yeah, and termite,
inspection.
yeah, that's going to be separate. That is required on a VA transaction.
A termite?
A termite is required on a VA only.
Mm-hmm.
It used to be that the veteran could not pay for that expense. Now the veteran can pay for that expense. And we'll go over what a buyer and seller can and cannot pay for in a little bit when we get to that page. But again, you have your home inspection. You also have a pest inspection. And even though it's not required on a conventional or an FHA loan, get a pest inspection on every transaction. Just get in the mindset. I need a pest inspection. I need a home inspection.
Those costs do they pay for those in advance of closing, or can they take those costs and roll those costs into their loan?
So the pest inspection, yes, we can pay that the day of closing. And this is one thing that we'll go over when we're negotiating a seller paying closing costs. I'll give you the correct verbiage, or I guess I've already given it to you, to where you're not potentially leaving any money on the table for a buyer. If you can negotiate that a seller's going to pay X amount of their cost, and if we covered all their closing costs required for a loan, and we have additional money left over that the seller can pay, well, we want them to pay inspections as well, which could include their home inspection or could include their pest inspection. So I've given you guys verbiage to set you and your buyers up for success, to where if a seller's going to pay X amount, let's have that include their inspection so we're not leaving money on the table. But yeah, that's a good question. But yeah, those are buyer's expenses. So again, pest inspection, your home inspection. Another thing, every once in a while, you might need a structural, like a structural engineer's inspection. If you have issues with cracked walls or foundation issues or maybe roof issues, a lot of times it's called out by someone. Hey, we might need a structural engineer to come out here, see if this home needs piers, if they need to kind of fix some braces in the roof or things like that. Those are, and it shows in the contract, those are buyer's expenses, but it doesn't mean that a seller cannot pay for it. If they negotiate that a seller will pay for it, that's perfectly fine. But if you have a buyer that says, well, I don't want to pay for this, I mean, you can point them out that in their contract, it does state that inspections are a buyer's expense. Okay. Or traditionally a buyer's expense.
But those costs, even though it's their expense, they're not bringing that money that day to pay for it. Can they say, I want to roll it into the total of my loan?
Well, they wouldn't finance them into their loan. So like if they wouldn't finance it and spread that cost over 30 years. They could pay that money the day of closing. And a lot of your inspectors will do that. Some of them might, charge an additional maybe $25 or so instead of paying me right now, if you pay me the day of closing. So if they have the money, they might save a little bit by just paying that day. And then you'll send those invoices to the title company so that, everybody knows ahead of time, hey, they've already paid for this pest inspection. We're not going to charge them at closing. But to answer your question, they can pay for it at that time of inspection or the day of closing, but they will not finance those costs into the loan.
Okay.
Is that what you were asking?
That was the question.
Got you. Yeah. Okay. Okay. So Larry will teach you, about the timing of your of the inspections. One thing I want to go over is, earnest money. So one thing that you'll see in the contract, you'll get your inspections, and it states in the contract, if the inspections aren't to the buyer's satisfaction, they don't have to purchase the home. they can get their earnest money back. Okay. Another thing that we'll go over in a little bit more detail is the appraisal of the home. Okay. So if your home doesn't appraise for the sales price, the buyer doesn't have to buy the home. Generally, you'd go back to the drawing board with the seller, or the two different realtors would try to renegotiate the sales price, because it would need to be, we would set our loan off of the lower of your sales price or appraised value. So let's just say you're buying a home for $100,000 and it only appraises for 95. There's a few different ways to go about this. First off, the buyer doesn't have to buy the home, and it states in their contract that if it doesn't appraise for sales price, they can get their owner's money back and try a different property. But generally speaking, they're going to want to make the deal work. So option one, or what normally happens, is you go back to the drawing board, try to get the seller to reduce the sales price down to your appraised value. That's what happens most frequently. If that doesn't happen, the seller can't budge, but your buyer still wants the home, well, they just bring a little bit more money to the, they just bring additional funds to kind of cover the shortage. Or obviously option three, they can walk from the contract and get their earnest money back and try again. But the contract does go over how inspections work, appraisal work, but I wanted to cover that with you guys just so you kind of understood the protections or the rights that a buyer has with this contract. As far as re-inspections, so this is pretty important. Paragraph 7E, let's talk new construction. Okay, so if we have a home that's being brand new home being built, we are going to go ahead and order our appraisal before the home is even done. And we do this for a timing point because typically, a day or two after the home is done, the builder is going to want to sell the home. But if we wait until the home is completely done to order the appraisal, it's kind of setting us back, maybe 2 or so weeks until we can close this transaction. So new construction, we'd order the appraisal ahead of time, and it's going to be mostly done but not finished. But that appraisal will say this home meets X value, $100,000, subject to being complete, per the plans and plans of your contract or so. So we'd get that appraisal done ahead of time, and then once the home is complete, we would send them back out for a re-inspection just to say, yes, the home is completely done. It was built per the contract that everybody created, value supported. Let's go ahead and close. So a re-inspection is also a buyer's expense. Okay, and we go over that with them. We'll let them know we're doing this appraisal ahead of time. We're going to have a final inspection. But that's how new construction works. Let's talk repairs, where you go out and the appraisal's done, and the appraiser sees that there's a sagging roof, there's broken windows, and there's no flooring in the house. That's going to be an issue with the value of the home. Okay, an appraisal is going to want to make sure that a home is safe, sanitary, and secure for a buyer. So if your roof's sagging, you have broken windows, and you have missing doors, that's not a good thing for this buyer. So the appraiser would say, hey, I'm going to support value of this home to be $100,000, but we're going to need an engineer to fix this roof or to take a look at the roof, or the roof needs to be replaced. You've got to replace the windows, and you've got to put a front door on there. Okay, so that's another instance where you would have a final inspection. If the appraiser calls out things that need to be done to this home to meet value, then the two different realtors involved will need to figure out who's going to be paying for those things. They need to be repaired, and then once everything's fixed, then the appraiser would go back out for another for a final inspection and say, yes, everything is squared away with this home. It's safe, sanitary, and secure, and value has been met. One thing that we've seen before is you might have a laundry list of things that the home is in poor shape. They need to be done. They might have 6 things. You need to fix this. You need to fix this, fix this, fix this. If you fix 5 of those 6 things when the appraiser goes out, he's going to have to do another inspection to make sure that 7th thing is taken care of. So whenever, it doesn't matter which side you're on, if you're representing the seller or the buyer, if the appraiser has called out several things that need to be done, make sure that all those things are done before they come out for this final. Otherwise, the buyer is going to have to pay another final inspection. And we've seen that before. And oftentimes it's little things. It's, a door on an electrical, like a panel box, or, just little stuff like that. But you don't want that buyer to pay an extra $100 to $150 trip fee over one small thing like that. That won't be well received. Okay. Any questions about that with, final inspections and whatnot? You will know, I didn't cover this, but on the previous page 207, 7A, it talks about making sure that all the utilities are on. Just about every transaction you're going to have, that's going to take place. But if you have, say, an older home, or a home that's been on the market, for years and years, or, winter and things like that, if they turn off the water to avoid any frozen pipes, you'll just want to think this through. Hey, are all my utilities on, so that when these inspections take place, either the appraiser or the home inspector will know that everything is working. So just going to keep that in the back of your mind. All my utilities need to be on. Okay, so page 4 of 7. So buyer's expense. Buyer at buyer's expense shall obtain a commitment or issuance of a title insurance policy. That's what you're going to check. The state of Oklahoma, we don't do attorney's title opinions. We have a title insurance policy on every transaction that happens in the state. And in a nutshell, what title insurance does is it protects the buyer to make sure they have clear title to a property, so that whenever they buy that, there aren't any existing liens against that home that would affect title to a property. So let's just say buyer lives in their house, they own it, and they don't file their federal taxes. Okay? A lien can be placed on their property because they did not file those taxes, and a lien can supersede a mortgage. Okay? That's a big issue. Whenever you talk about mortgages, you'll talk about like a position, like a general mortgage is going to be in first position. So that means if anybody needs to be paid off, like when you sell a home, the person in first position gets paid off first. If you have a second mortgage, like a home equity line of credit, things like that, you have your first mortgage in place, that second mortgage is put in second position. So if you have to sell a home, your first mortgage is paid off first, your second mortgage is paid off second, okay? Liens supersede mortgages. So now you have something other than your first mortgage that has to be paid off before your mortgage is paid off. That's a big issue. And title insurance policies protect that from happening. So one of the things that they'll do is they'll check to see, hey, are there any liens tied to this property that could affect the position of your mortgage? That's one of the things that they check. The other thing that they check is how the transfer of title has been passed, from seller to buyer, to make sure that everything was documented properly. If there were any, document that wasn't signed correctly, a deed that wasn't executed correctly, things like that, the title insurance policy will protect this new buyer from someone 3 years later down the road saying, well, actually, you don't really own this home. It's my house, so you got to go. It protects against those things. So making sure there aren't any liens, tied to the property, and that the owner has clear title. There's no issues with their title of ownership to that property. Okay? That's title insurance in a nutshell. So we'll always have a title insurance policy with the transaction that guarantees that, that guarantees those things. And if there were any issues later on down the road with their chain of title or with the lien that was missed, the title, it's like an insurance policy. That policy will it'll take care of the cost of fixing any of those issues. Okay? So just like homeowners insurance, this is insurance for your title to your property. Does that make sense?
Yeah, it does. Has it ever happened that, let's just say the insurance company loses and it's really whoever's house that showed up? Does that ever happen? I mean,
Now say that again.
Like somebody shows up and says, hey, this is mine. The title didn't get passed correctly.
No, that wouldn't happen because again, that's their job in this transaction to make sure that things are passed. And if it's not, then the title company has to pay to get those things fixed. Okay. But I mean, that's them doing their due diligence, and getting their title work and their title commitment, like all the things that they do, ensure against that from happening. Mm-hmm. I mean, Larry, can you think of a time where, I mean, I haven't experienced one where, say, someone, chain of title was messed up or a deed was messed up to where someone actually said, hey, you don't own this home, and the title company couldn't fix it.
The only time that happens to us in Oklahoma is we've got treaty issues on former Indian land.
Okay.
So we don't have much of a problem in our area. But
Yeah.
if you're in some of the, you get down south, even around Ada,
Mhm.
where it's more Indian. If property hasn't been on the market for a number of years, it goes on the market. Tribes have offices that watch for that.
Mhm.
I've seen that one time.
Okay.
I've seen the attempted more than once, but
Yeah.
succeeded once.
Yeah. Again, people, I mean, you could attempt anything that you want, but again, that's the whole purpose of this title insurance, and that's why it's such an important thing for your buyers to protect against that,
Right.
so that they don't have to deal with that, because that would be a nightmare.
Yeah.
That'd be a big deal, a very big deal. But yeah, good question. Okay, so another thing that is now a buyer's expense is you're getting a survey done on the home. There's a couple different ways to do a survey. One of them is called a pin stake survey that can get pretty expensive. And especially if you have acreage and things like that, it can be very expensive. But generally speaking, for all your existing lot block, residential homes, a buyer's not going to need a pin stake survey done. They'll get what's called a mortgage inspection report, where a surveyor goes out. They basically draw, their plot of land, where the home is on the property, if they might have, a shed or any concrete fixtures on the property, and they draw out like all of your easements. Say you got and I can draw this really quick. So let's just say this is your plot, okay? And you've got your home here. You've got, I don't know, a little concrete slab here for your AC unit, and you've got a little shed back here in the back, okay? Part of your survey, and again, this is a mortgage inspection certificate. A pin stake survey, they would go out and actually find the pins to know where your boundary lines are. They'd look at these pins, and if you haven't done it yet, go check, at the corner of your yard. You'll see, or you should be able to see a pin there that designates the boundaries of your property. If someone needed to put a brand new fence in or something like that, they would need a pin stake survey for determining property boundaries. We don't need that for this survey that we're doing for this transaction. The whole purpose of this mortgage inspection certificate, or MIC, is just to determine that the property, the home and improvements are within your boundaries, that you're not, a little bit on your neighbor's, property or anything like that, and also that you don't have any permanent fixtures on your easements. So one thing that you guys will learn at the front of your home, there's typically always like a building easement to where like your home can't be X amount of feet, to the curb or whatever. Some neighborhoods or some HOAs, are very particular about that. Some of them it's not, as big of a deal, but that's one easement that we need to look at, your building line easement. Sorry, I'm getting all tongue-tied. In the back, you'll have your utility easement. So this is an easement where, your electric, your gas, the cable companies and whatnot, they have access to this back portion. It's their easement to lay their lines and do repairs and things like that. So kind of the purpose of this is you would not want to build a swimming pool within this easement, because if they need to maintain lines or dig up lines, they are not responsible for repairing anything that they have to move or dig up that is on their easement. Okay?
I feel like they got half of my backyard, or over half of my backyard.
Well, I'm sorry about that. But yeah, so like the day that you purchase the home, they give you a copy of this survey and they let you know, hey, here are all the easements. So don't put a pool in your utility easement. Don't put a shop with a permanent foundation. Like my backyard, I have a big swing set that's over my utility easement. I can move that. It's no big deal. But if they had to dig up things and I had, a concrete foundation underneath my patio or my swing set or whatever, they could jackhammer that up, and I can't go after them to replace that because it's within that easement. That makes sense? Okay. And the title company, they'll probably go over a little bit more about easements and whatnot, but I just wanted y'all to understand the difference between a pen stake survey, finding out where your stakes are, and the purposes of this MIC or mortgage inspection certificate, just going over, that your home is within your property boundaries and knowing where your easements are.
If you're buying rural property, is it typical to go the other way? So you can find out the true boundaries on rural property?
Yeah.
Okay.
Yeah, it is. And one thing that I would recommend doing is if you do need to get a pen stake survey, because they can be expensive, get several different quotes. Because again, if you're talking, 15 acres or whatnot, if there's no trees, it's a pretty, it's a straight shot, and around here it's fairly flat, so it's not as difficult to do. But if you have a bunch of trees and hills and things like that, it can get expensive pretty quick, especially for your larger acreages. So again, you might want to get with a broker, get with another experienced realtor, and just say, hey, do you have any contact information for surveyors if you needed a pen stake? This one here that's required for this transaction, the mortgage company will order that, just like they order the appraisal, so y'all won't need to take care of that. But again, if you check that you want a pen stake survey instead of a mortgage inspection report, you're stating that they're going to pay several $100s to get this other type of inspection that's most likely not even needed.
Is it on here?
Yeah, so we are on C, page 4 of 7, C.
Okay.
Yeah.
I was gonna say, I know when I bought my house, the building easement,
Uh-huh.
because it's an older house and they put the building easement after the house was built.
Mhm.
I'm technically 1 foot past that easement,
Okay.
and so I had to sign a waiver
Yeah.
saying that I understand it's 1 foot and all this other stuff. So if I change anything, I have to put it back past that easement.
Yeah, definitely. And so that's so for that they I believe what it's called, they had you sign like a hold harmless kind of clause where they're acknowledging, and we've seen this many times before on let's just say way back when, if you've got your sometimes you'll either see it on the front like you were talking about, or let's just say you have, if this is not the boundary between you and your neighbor's house, if you've got like a building line, maybe right here, we've seen that this little foundation for your AC unit, sometimes that can be half a foot over that line, or different unique things like that. The title company will still give you this policy, but they'll note that as an exception. So they're still going to give you this insurance policy for your title, but if for whatever reason someone needed to move that that cement foundation, you might be on the hook for that. Okay, so that's most likely what you sign. But yeah, things like that happen. It's just an extra document or so that the buyer will sign, just acknowledging, hey, there's something a little bit unique about your home and these boundaries, but we're still going to give you this title policy.
Okay.
Yeah. Okay. 11. This is just going over prorations that your seller is responsible for. So they're going to be taking care of any prorated taxes from January 1st through the day of closing. And at closing, all this gets squared up. So whenever your seller, your seller's going to have expenses to sell the home, property taxes is one of them. Buyer is responsible for taxes the day they purchase that home through the end of the year. Seller will pay taxes from January 1st through the day they sell the home. And all that gets squared away with the title company at closing. If there were any other prorations, water districts, things like that, you don't see those very commonly, but like HOA dues, that's another fairly common thing. Your seller's going to pay their prorated portion, buyer pays their prorated portion through the end of the year. But it does show, dock stamps, utility bills, any other things like that. Those are common seller's expenses. One thing I will advise you on, if you're ever working with a buyer that's buying a brand new home, some builders use their own builder's purchase contract that reflects the builder is not paying dock stamps for this transaction. Okay? Dock stamps are essentially a seller of we're making this transaction public record. Okay, doc stamp shows that the seller has sold the home to the buyer for X amount, and that's made public record. That's what your doc stamps are. General, and we talked about it a few different times, general rule of thumb is your seller is going to pay that expense, but every once in a while, new construction, you'll have a builder's contract state that the buyer is responsible for those doc stamps. So if you just want to make a note to the side, check builder's contract about doc stamps, because that can be several $100s depending on, the price of your home. And that's important. We'll catch that, but if you guys catch that as well, to know who's going to be paying doc stamps for new construction. Okay. Paragraph 13. So whenever we talk about sellers paying portions of your buyer's closing costs, this is one place where you can write that. A lot of times, whenever you'll write in your contract that if there's termites found, that a seller is going to do a full barrier treatment, paragraph 13 is normally where you put that. You cannot, like I said, you can always put, if your seller is going to be paying buyer's closing costs, this is a spot where you can put that. It can also go in your financing supplement, and that's more commonly where it is. But any provisions or any kind of things that haven't already been automatically mentioned in the purchase contract that you're doing for this transaction, paragraph 13 is the place to put that. Okay, that's just kind of your
Do you advise repeating, on the finance supplement if you're asking for closing costs or whatever? Do you advise go ahead and add it in here too?
I do. That way, it's seen more than once in the contract and everybody's on the same page as far as the seller paying a portion of the buyer's closing costs. It does not hurt to have it more than once, but you have to at least have it once. Yeah. So again, I like to put it in the body of the contract and have the same information on the financing supplement as well, just so everybody's on the same page. Yeah. Okay. And then page 7 of 7. Obviously, if everybody's agreed to this initial offer, you're going to have 2 signatures on this contract. So your buyer's going to sign, your seller's going to sign. If there's any counter offers, then you would have a separate page, that has all the signatures to where this contract is agreed to in your counter offer. So your buyer might initially offer, I want to buy your house for $100,000, and I want you to pay $3,000 of my closing cost. Your buyer or your seller says, no, I'll sell it to you for $100,000, but I'm only going to pay $1,000 of your closing cost. Then you would have a counter to this contract signed by both parties, so everybody knows what are the final terms being agreed to. Okay. As far as earnest money, again, we're going to list the amount of the earnest money. And it says here cash as earnest money deposit. Again, we talked about this earlier. There's no way for us to verify cash. So just go ahead and strike out cash. They either need to, the simplest way is for them to write a check for this earnest money. Because we're going to give them credit for this earnest money. Let's just say it's $1,000. Okay, so the day that they go out and sign this contract, they're writing a check for earnest money, which is basically a deposit on the home. So the seller knows you're serious about buying this. We're going to take it off the market. They will pay $1,000 up front, and those funds will come out of their bank. The day that they purchase the home, they will get a credit for that $1,000. So they pay $1,000 now. They'll have to pay $1,000 less the day they purchase the home. And if you write a check, whenever we get your bank statements, I can see those funds coming out of your account, so I can give you credit for it. If you do, we have some people that have cash on hand. They go to the bank, they get a money order, and they do their money order as their earnest money. Well, again, I want to ingrain this in y'all's heads. There's no way for us to verify cash, so I can't give them credit for that earnest money because I can't prove where that money came from. And that gets a little bit complicated. So again, the easiest thing, if you have earnest money, have them write a check, okay? Or they could do a cashier's check as well. If they pull money out of their bank to do a cashier's check, no cash.
And you said that money goes toward the actual loan, or it goes towards the fees?
So it reduces the amount of money that they are required to bring the day of closing. So just think like when you purchase a home, you have 3 costs associated with the transaction. You have your down payment, your closing cost, or your costs associated with making the loan, like getting this title work done, having your appraisal done, recording fees and things like that. Those are closing costs. Then you have prepaids, which are essentially property taxes and homeowners insurance. Or setting up an escrow account for taxes and insurance. Are all y'all familiar with escrow, or like an escrow account and kind of what that is?
It just kind of holds it there.
They're
Yeah.
just borrowing your money so they can pay the insurance when it comes up.
Kind of, yeah. It's basically like a built-in savings account. So each
Yeah.
month, if you have an escrow account, each month whenever you make your mortgage payment, you're paying your principal and interest, your insurance, your property taxes, mortgage insurance if you have it. Okay, so you're making one check to your mortgage company. If you have an escrow account, the taxes and insurance are set aside in this escrow account. So each month you're paying 1/12 of your taxes, 1/12 of your insurance. In December, when property taxes are done, the buyer's not, or the homeowner, they don't write a check to the county assessor. That's paid for from this escrow account they've been contributing to all year. Okay. So when you purchase a home, you also pay the first year of homeowners insurance up front. So the day of closing, you're going to be paid in full for your first year. On your 1-year anniversary, when your policy renews, you won't write a check to your insurance agent. It's paid for from this escrow account you've been contributing to. So it's just one less thing for customers to worry about. You just pay your mortgage every month. And then when taxes and insurance are due, those 2 big bills are paid for from this account you've already been contributing to. If you have a conventional loan, not government, so no FHA, no VA, but if you have a conventional loan and you put down 20% or more, you have the option to pay your own taxes and insurance where you don't have an escrow account. Some people prefer that. Let's just say if you, like your commission, or you get certain bonuses, towards the end of the year or things like that, or your income fluctuates. For those people, it might make sense to pay their own taxes and insurance so they can save money throughout the year. Whenever they get their Christmas bonus, they know, hey, that's for taxes and that's for my insurance. But again, you'd have to have a conventional loan and put down 20% or more to have that option. So any VA loans, we're setting up an escrow account. Any FHA loans, we're setting up an escrow account. Conventional loan, 15% down, we're setting up an escrow account. You got it. You guys are pros. Y'all got this. So does that make sense? Y'all feel good about escrow? Okay. So we talked about that. You'll also list the information for the title company. So if you haven't done it previously, the name of the title company, and then also their address. That really helps us out because whenever we send our order to, get this title work started, we'll know who to send it to. If you just list, if you don't list anything, we have no idea. But if you say, First Title, they have several different locations. So we'll want to know, are we sending this to Midwest City, to Edmond, down south? So just get used to putting all that information in. And then we need at least one realtor's signature for receipt of the earnest money. So somebody, typically the buyer's agent, has taken this cashier's check and they're going to take it to the title company and they're stating that, they have received this earnest money. Okay. And then the next page, this is plain Jane, just the contact information for both realtors involved. One of the things that we do, and it's very helpful to you, whether you're a buyer's agent or a seller's agent, is throughout the process, we'd send these updates to let both parties know kind of where we're at in the transaction. So once we have a completed loan application and we've sent their disclosures, both agents will get an email saying, hey, congratulations, we're moving forward in this process. We're getting the appraisal ordered. When we have the appraisal back, hey, everybody, we want you to know we're still making good progress. We got our appraisal back. Hey, this loan is clear to close. We have all of our conditions. Now we're just waiting for closing to happen. Both sides get those updates. And even as a seller's agent, some companies don't provide that information to them. As a seller's agent, they're kind of more involved with the buyer's agent. But it's good for you to have peace of mind of knowing that, the lender for the buyer of this property, they're on top of it. They're taking care of things and I'm getting updates from them. That's part of the reason why, we want to get this information. so that everybody's, up to date on what's going on. And if there's any issues, we can communicate that accordingly with everybody. Okay. So we have just a little bit more. I want to go through just the financing supplements, just 3 of them here, and then we'll take a quick break and then go over some more stuff. So the first one, conventional loan. So again, I made all these notes for you just to kind of keep it easy, but you can make notes on this if you need to. Top line, just the street address of the property. As far as paragraph 1, the loan. So the contract is contingent upon buyer qualifying for a conventional loan and the amount of blank plus private mortgage insurance. So we talked about this earlier, and as we're going through this, I want you guys to pick out these 2 flyers right here, the financing basics and the one that this is kind of a fees cheat sheet. Just kind of put those to the side as we're working through this part of the contract. So on a conventional loan, we talked about this. If you put down 20% or more, there is no mortgage insurance whatsoever. Okay? Pardon me?
I think that's.
Oh, sorry. Yeah, this right here. This is kind of our fee cheat sheet, and this is a financing basics sheet. So just kind of have both of those out. Again, we're just talking conventional right now. If you have a 20% or more down payment of the purchase price of the home, there's no mortgage insurance at all. Nothing upfront that's financed into the loan, nothing in your monthly payment. It just doesn't exist. If you have less than 20% down payment, you will have mortgage insurance. Most typically, we include it in your monthly payment. But there are some times where it makes sense where instead of paying that in your monthly payment, we can do a one-time fee. It's either paid in cash or we can put that into the loan and spread it over 30 years or 20 years or 15 years so that they don't have any monthly premium. Okay? But less than 20% down, there will be some form of mortgage insurance. On a conventional loan, eventually the mortgage insurance goes away. So over time, as they pay down the principal of their home and they establish equity, eventually conventional mortgage insurance goes away. So that's a good thing. As far as, say, credit scores and determining what might make sense for a customer, structuring the type of financing that they have. Let's talk interest rates really quick and how credit scores affect interest rates. The higher the credit score that you have, typically the lower the interest rate that you're going to have. Think of it as risk-based pricing. If you're a higher risk because you have lower credit score and you don't pay your bills on time, the statistical likelihood of you defaulting on this mortgage is higher. You're more of a risk, so your interest rate will be higher to offset that risk. Okay? The same thing goes true with conventional mortgage insurance. So if you have lower credit scores on a conventional loan, your mortgage insurance is going to have a higher premium. Okay? On the flip side, if you have really good credit, your interest rate is going to be lower, and the mortgage insurance on a conventional loan will be lower as well. So conventional MI, and if y'all want to make a little note, just right above, you could just say risk-based pricing. Okay? So you have great credit, lower interest rate, lower mortgage insurance premium. That just kind of makes sense. Lower credit score, higher interest rate, higher mortgage insurance premium. Let's compare that to, say, an FHA loan. With the interest rate, it's still the same thing, where if you have a lower credit score, you're going to have a higher interest rate. But the mortgage insurance is a flat fee for everybody else. So if you have great credit scores, it doesn't matter if you have an 800 credit score or a 620 credit score on an FHA loan, your mortgage insurance is just a percentage of your loan amount. So you might have a customer that says, well, I don't really know the difference between an FHA loan and a conventional loan. One of the things is, one of the questions we'll ask, hey, what does your credit look like? If you have really good credit and you have let's just say you have funds to put 20% down, it's going to make sense for you to get a conventional loan because you wouldn't have any mortgage insurance at all. On an FHA loan, it doesn't matter if you put 20 or 50% down. If you have an FHA loan, you will always have mortgage insurance. Okay? So that's one of the questions that we ask when we meet someone. Hey, tell me a little bit about, yourself. What are you looking to accomplish? Do you know what your credit looks like? How much money do you have to put down on this home? Those are the questions that we ask, so I'll know, hey, what's going to be best for this particular person? I think conventional might be best for them. Or, we don't have much to put down. We have a lower credit score. FHA is going to be our friend. Okay? Does all that kind of make sense as far as mortgage insurance and kind of credit scores and how that works? Okay, perfect. So if we go back to the conventional financing sheet, the loan is contingent on the buyer qualifying for a loan in the amount of blank plus the mortgage insurance. So you'll just do simple math here. If you have a 95% loan, like you're buying a home for $100,000, putting 5% down, your loan is going to be $95,000 before you add any mortgage insurance fees to the loan. Does that make sense? So just a cheat sheet, a base loan before you consider any mortgage insurance. As far as your loan closing cost, again, we kind of see this down in paragraph 3. The buyer is going to pay at the time of closing any loan cost, including, if applicable, origination fee or discount points. We talked about this. They're going to pay the first year's home insurance premium, if applicable, flood insurance premium. We'll talk about flood insurance in a little bit. Tax and insurance escrow deposits, and then interest beginning the day the loan closes through the end of the month. So that's kind of a mouthful, so let's break this down piece by piece. As far as origination fees or discount points, just raise your hand if you've heard that term before, if you've paid those fees yourself, or if you know what they are. What's that?
Heard them in class.
Okay. So whenever you hear origination fees or points, the simplest way to explain that is those are additional costs that you would pay to lower your interest rate. A lot of times if you go on, FannieMae.com, or if you just hear on MSN, they're talking about, what mortgage rates are. Most of those times you're going to hear a low rate, but you'll see an asterisk. This is paying half a point in, or half a point, or 0.5% in origination fees. A point or origination fee is a percentage of the loan. So if you have a $100,000 loan and you have 1 point, that's $1,000. Okay, 1% of your loan amount. So if you have this interest rate and you're paying 1 point, on top of all the standard fees, you are paying additional fees to have that interest rate. Some people prefer that because for the life of the loan, they want to have a lower rate. Some people, and for those people, it might make sense. If we're discussing points with a customer, and if you want to pay these additional fees to have a lower interest rate, I calculate a break-even point for you. So if you're going to pay X amount to save $10, $12, $20 a month, you need to know after how many months was that money well spent. The average American lives in a home or has a mortgage on the books for 4 to 5 years before they either sell the home or they do a refinance. So if you're going to pay $3,000 to save, $6 a month, and it's going to take you, 6 years to break even, I don't see that as money well spent. Does that make sense? That's kind of fees or origination points. They're not very common, but some of your customers will want information about it, so now you know what that is and you can explain it to them. Loan closing costs. So again, we talked about that. The first year hazard insurance premium, we talked about that with escrows already. Tax and insurance escrow deposits. Okay. So we pay our first year of homeowners insurance up front, and we collect a few months reserves of taxes and of insurance. Okay. The reason we're doing that is you'll see in D, you're going to pay interest beginning the day of closing through the end of the month. So if you buy a home today on September 22nd, you're going to pay interest from today through the end of the month, and you'd bring $15,000 or whatever it costs to purchase the home, your down payment, closing costs, prepaids. You'd buy your home and sign all the documents in September, make no payment in October, make your first payment November 1st. So that's kind of the timing. So like pretty frequently we have customers that are in a lease in an apartment or they're renting a home. and they're trying to budget, okay, I've got to pay my last, month's rent to the apartment. I got to figure out when I'm going to pay my first mortgage, because they need to know that information. We tell them, but it's good for you to know as well. Hey, for budgeting purposes, if you buy your home in 1 month, you skip a month before you, and then you make your first month's payment. So that kind of, that might free up a 1 month's mortgage or rent payment for them to transfer over their utilities if they need to get movers and, buy a couch or whatever, just to go over kind of what their budgeting is going to look like, for this transaction. That makes sense? Perfect. So those go over all of your cost. Okay, so the verbiage that we talked about, if you have a seller that's going to be paying closing costs for your buyer, here's the verbiage that I want you guys to use so that you're not leaving any money on the table. So seller shall pay up to whatever dollar amount of buyer's closing cost, prepaids, and inspections. Within the real estate community, there are different interpretations on what closing costs are. Most people might associate closing costs being your closing cost and your prepaids. Some sellers would say, no, I'm only going to pay your closing costs. I'm not going to contribute towards your taxes and insurance. So if you say closing costs, you might be meaning both. One person might be only meaning one of those expenses. So that's why I like to make it very clear for everybody: closing costs, prepaids, and we include inspections, because if the sellers agreed to pay X amount, but their closing costs and prepaids do not exceed that, then we have additional money we're leaving on the table that could go towards their home inspection or their pest inspection or things like that. So I just put it in here because this is the most user-friendly verbiage for you guys to have, that they're going to pay X amount of buyer's closing costs, prepaids, and inspections. Okay? And then I made some notes as far as how much a seller can pay for each different type of financing. It gets a little bit confusing, but again, I made notes, and if you ever have questions, give me a call. If you have less than a 10% down payment, the seller can pay 3% of the sales price towards the buyer's closing costs. So you have a $100,000 sales price. If your buyer has less than a 10% down payment, seller can only pay $3,000 towards closing costs, prepaids, and inspections. Okay? If they have a 10% or greater down payment, they can pay up to 6%. And then if it's a non-owner occupied or an investment property, the seller can only pay 2% of the sales price towards their closing costs, prepaids, and inspections. So just little cheat sheets for you guys to save, because whenever you're negotiating a contract, and the buyer's getting a 5% down payment on a conventional loan, you're not going to want to ask them to pay $6,000 and let your buyer think that they're going to pay $6,000 of their costs if they can only pay $3,000. So this is good for you guys to kind of know whenever you're writing up your contracts. FHA loan, again, pretty much same format, street address up at the top. Here again, as far as the loan, they're getting an FHA insured loan in the amount of blank plus their private mortgage insurance premium. So we talked about conventional mortgage insurance, and y'all are pretty comfortable with that. Most likely just a monthly mortgage insurance premium, but they can, in lieu of doing a monthly payment, either finance or pay in cash a one-time fee up front. On FHA, you have two different forms of mortgage insurance. And you'll see right here on this little middle box. Okay, so you have an upfront MIP or mortgage insurance premium. That's 1.75% of the loan amount. Y'all don't need to calculate. We do all that for you, but I just want you to know there's an upfront fee that we finance into the loan, plus they pay monthly mortgage insurance. Okay, so whenever you're filling out this FHA financing supplement, you just need to figure out what their base loan is. You don't have to do math and include, well, what's this other 1.75%? Okay, you just the simple, if they're doing a 3.5% down payment, which is your minimum for an FHA loan, 100,000 times 96.5%, that'd be a $96,500 loan. Okay. Not everybody's good at math, so again, you guys don't have to calculate any of this. You could say, hey, Gordon, I need your help. I need you to make me an example of financing, and I need your help filling out these forms. I'm perfectly fine with doing that. And after you do it, you'll get comfortable with it. But again, never hesitate to give me or Kathy a call and say, hey, I want to come up to the office and sit down with you 10 minutes just to go over this stuff. We're perfectly fine with doing that. Okay. Paragraph 2, the FHA amendatory clause. So we talked earlier, if your home doesn't appraise for the sales price, the buyer doesn't have to purchase the home. This is a specific verbiage for an FHA contract that just reiterates that. Again, this whole paragraph is just saying that if your home doesn't appraise for the sales price, the buyer doesn't have to buy the home. So a lot of times you might have a counter or go back and forth on the price in your negotiations. Whenever we receive this financing supplement, I just need this final sales price. So if you start off making an offer at $100,000, then it goes to $90,000, and then you settle at $95,000. Just do your lender a favor and remake this page. There's no signatures on it. It just says your final sales price is $95,000. Does that make sense? Because if this document says that, you know, your initial offer and you prepare this, if the home doesn't appraise for $100,000, my buyer's not going to buy it, and you finally agree on a sales price of $95,000, this document that hasn't been changed says that they're buying it for $95,000. If it doesn't appraise for $100,000, they don't have to buy it. That doesn't make sense. Okay, so just general rule of thumb: give your lender this page that has the final sales price that you negotiated for the contract. Okay, and then the next page. This is all very simple. Goes over the costs that the buyer is responsible to pay for, and we've discussed these items already. Non-allowables. This is one thing that FHA and VA used to have. This is paragraph B1. Loan costs that FHA will not allow buyer to pay. They no longer exist. There used to be times where on an FHA loan and a VA loan, there were certain costs that the buyer was not allowed to pay, like that a seller had to pay, but they've gone away with all of those. They haven't updated the contract, to reflect that. But there are no FHA non-allowables and there are no VA non-allowables. So I just put in here, if you see that, just write NA. The paragraph under that is where you would say, hey, if my seller wants to pay, $3,000 of closing costs, you would put that in B2. So in addition, seller agrees to pay on behalf of buyer discount points, closing costs, which include your prepaids, escrows, origination fees, and other allowables not to exceed. That's where you're going to say how much your seller is going to pay. Okay? All that makes sense? Okay? And then again, I gave you the verbiage here. Seller shall pay up to blank of buyer's closing costs, prepaids, and inspections. On FHA loans, the seller can pay up to 6% of the sales price. So you don't have all the confusion of, well, what about their down payment? It's just a flat 6%. There's also no investment. You cannot get an FHA loan for an investment property. FHA loans and VA loans are primary residence only. So that's why you don't have a clause about non-owner occupied. If you have someone who's buying an investment property, they will only get conventional financing. Okay? Both people sign this. And this is one other thing that commonly is missed. So there's another the FHA real estate certification. Even if there are counters, you go back and forth on sales price, everybody still needs to sign this certification. The buyer, the seller, and both agents need to sign this. And this is just saying that there are no other agreements outside of this contract for the transfer of this property. It's just an FHA special document that needs to be signed. So just make sure that we have both buyers, or all buyers, all sellers, and all agent signatures on this form, even if there are counters back and forth. Okay. And then lastly, VA, since you guys are pretty familiar with this, again, the VA, in terms of mortgage insurance, they have no monthly mortgage insurance. That's one of the awesome things about a VA loan. No monthly mortgage insurance. If the veteran is if they are not at all disabled or less than 10% disabled from a service-related incident, then they will have an upfront, or it's called a VA guarantee fee. think of it just like an upfront mortgage insurance premium that's financed into the loan. Okay? If they are 10% or more disabled, they do not have this fee. So if you have someone who's 10 or 15 or 100% disabled, they have no upfront fee that's financed into their loan. They have no monthly mortgage insurance type. So 99 out of 100 times, if you have a veteran that qualifies for a VA loan, it's going to be the best way to go for them. Hands down. There are very few exceptions where if someone qualifies for a VA loan, it does not make sense for them to get the VA loan. We're approved and we do VA loans all the time. Our underwriter has been doing VA loans for over 30 years. She sits 10 feet away from me. Very familiar with VA guidelines and things like that. So we love doing VA loans. Another great thing is our company does not charge a buyer an appraisal fee on a VA loan. That's one of the ways that we just want to thank our veterans for the service that they've done. We waive that $500 appraisal fee and any re-inspections for a VA loan as a great way to just say thank you. So just kind of keep that in mind. So we've gone over the loan amount for this VA, talks about the cost that the veteran is required to pay for this transaction. And then again, we've got our I put NA for VA non-allowables. There are no longer costs that that the veteran is not able to pay. So all these costs for a transaction the veteran can pay, so we just say not applicable on paragraph 4. And then again, I just put the verbiage in there as far as closing costs. Seller shall pay up to blank a buyer's closing costs, prepaids, and inspections. The general rule of thumb, it's kind of an asterisk, so it's not a very clear answer, but without getting complicated, sellers on a VA transaction can pay up to 4% of the buyer's closing costs, prepaids, and inspections. Okay. Any questions about the contracts? Again, there's a lot more to it than I went over, but I want to hit the nuts and the bolts that pertain to financing. So after you finish the contract class with Larry, if you have any other questions, give me a call and say, hey, well, how does this work? Or, what do I need to know about this? But that's generally most of what you should need to know about the contract that pertains to financing. Okay? Any questions before we take just a little break?
Don't give them a break. Keep it up.
Okay? No break. Even better.
But they're gonna get a lunch break right after you're done.
Okay, got you. Okay.
How
So
much longer do you have to go?
not too much. I mean,
Okay,
that's
good.
the bulk of this class.
I overscheduled today's reason. My bad.
No, you're fine. But yeah, I mean, a lot of this I've given you in handouts as a reference. You don't need to get a mortgage calculator. You don't need to memorize this. You don't need to take pictures. I mean, you can if you want to. The main thing that you guys need to know is just put me and Kathy's cell phone number in your phone. And if you ever have a question, hey, Gordon, what do I do? How much can this seller pay in closing costs? Whatever the case might be, just give us a call and we'll help you through this. So we've got a pretty good foundation as far as the different types of loans, right? We've talked about the mortgage insurance. We've talked a little bit about credit and how those things are. I just want to reiterate the mortgage insurance for you one more time. So conventional loans, see who's paying attention. If you have a 15% down payment on a conventional loan, is there mortgage insurance?
I don't know.
Yes.
Yes?
If you pay, so
Okay.
you pay 20%.
Correct. If you pay 20% or more on a conventional loan, no mortgage insurance. Okay? Question for you. Let's just say you got that 15% down, so you have to have mortgage insurance. What are 2 ways you can structure it?
To get what out of it?
Well, what are the 2 different ways that are that you pay your mortgage insurance on a conventional loan?
Mm-hmm.
There's 2 different ways to do it. Do you remember?
No.
That's good. Then you just call Gordon and you say, hey, Gordon, I don't remember how to do this. How do I do it? And I'll tell you. It's as simple as that. But yeah,
You pay it
so
monthly or
most people, they pay it in their monthly payment, or there's a one-time fee you can pay, whenever you purchase the home, conventional loan. mostly monthly, but sometimes it makes sense to just pay a one-time fee. On FHA, yes.
Is it cheaper to pay it upfront?
Well, part of that, part of that depends on the person. I mean, if you look at the one-time fee that's going to be paid up front versus how much you would pay, for several years in your monthly payment, mathematically, it is cheaper to pay a one-time premium.
You don't pay any interest.
Correct, but not everybody has the cash to do it. And then some people might make additional principal payments on their loan to get rid of that mortgage insurance sooner or quicker. But let's just say, if you have a one-time fee that you finance into the loan, you've rolled that into your loan. So if you get relocated and you sell your home in 2 years or whatever, you can't get that money back. It's rolled into your loan, so it's done and done with. So if let's just say if someone's in the military or they're relocating for a job and they might hop around, I wouldn't advise them to do that one-time premium. I'd say just pay it monthly, because you don't know how long, you don't know if that'll make sense for you. For some people that are going to make additional principal payments each month and just going to hustle to pay down that mortgage, for them I'd say don't finance, don't pay cash for a single premium. You'll only have this mortgage insurance for a small, period of time. So that's kind of one of those situations that's very custom for customer to customer, and we have that conversation with them. Okay. Then VA, just to reiterate, there's no monthly mortgage insurance. If you're 10% or more disabled, there's no upfront fee. Okay. And there's about 13 different ways to calculate this funding fee if you are not disabled. So I've given you three different general rule of thumbs, but again, we look up all that. I just wanted to give you a few different numbers. If you ever have questions, give us a call and we'll go over that with you. As far as the loan amounts, I didn't go over this earlier, but we've got conventional FHA and VA loan amounts. So these changed in December, or they changed in January. Typically each year or maybe every couple of years they'll increase these. Which is a good thing. As far as jumbo financing, that is a type of financing that we offer, and you'll eventually do one of those with your clients. On a conventional loan, anything that's over $453,100 loan, like that's the maximum that you can get with a conventional loan. So Fannie Mae, Freddie Mac, that's the maximum amount they will lend on a mortgage. If you exceed that, you get into the jumbo world. And jumbo, in a nutshell, can be a little bit more difficult in terms of underwriting and qualification for a customer. For some, if you're buying $1 million house and you need an $800,000 loan, a conventional loan isn't an option. You need to do jumbo financing. And for a lot of those people, it's fairly straightforward. For some of your customers that are self-employed, they have 6 different businesses, they have pass-through entities for their taxes, underwriting on a jumbo loan might be a little bit difficult of a process. So sometimes you can avoid jumbo, sometimes you can't. We talked about this 453-1. Let's just say someone needs to borrow $500,000. An option that we could do instead of doing a jumbo loan that can be a little bit more difficult to qualify, we might consider doing a $453,000 Fannie Mae loan and getting with a bank and doing a second loan, like a second mortgage. So between your first and second, you taking care of all the financing or the loan that they need. A little bit easier than jumbo underwriting, and we've saved the deal. Okay, and that's I don't want to go too much into that. I just want to let you talk a little bit about jumbo financing. That it's anything that exceeds this $453,000 loan, and the underwriting criteria is going to be a little bit more strict for a customer. Okay, they're going to look at higher credit scores, typically minimum of 10% down payment, and again the underwriting is not always a breeze, but they definitely they're not a nightmare or anything like that. But just wanted to touch on that with you. So we've got loan amounts. We've talked about the mortgage insurance. Now we're going to talk about the different fees. This is what you were asking me about. So we have just a blanket processing fee of $995 that encompasses several of these below fees. So we just say, our processing fee is $9.95, but that includes the document prep or doc prep, not the doc stamps that we talked about earlier, which is, making public record the transfer of this property. The document prep is a fee of having all these documents that they're going to sign the day of closing, making sure all of them are compliant and in the right order, and we have the right forms to do this, transaction legally. Okay. The underwriting, fairly straightforward. The processing and the underwriting of your file. And whenever when a mortgage company or a bank, they take care of a mortgage, every once in a while those loans can be pulled for audit. So the cost for an audit by a third party to make sure everything was done correctly is included in this underwriting fee. As far as federal tax transcript fee or getting tax transcripts, whenever we do a loan, we need to make sure that the tax returns and the income that a borrower provides to the bank or the mortgage company is the same information that they provided to the IRS. There are instances where they'll submit one return to the IRS, and then whenever we get their documents to qualify, we're not seeing the same info.
I had somebody kind of like that one day. Yeah, they called it per diem. For somehow they were getting they were making $28 an hour, and 8 of it's what they were claiming. They were claiming $8 an hour, and $20 was their per diem. And then it turned out the type of business they worked for, they couldn't do that.
Oh, really? Got you.
So basically, get a different job, or
Well, it sounds like that might be a little bit different of kind of the intent of this. I think the general intent of this is to prevent fraud, or if they were, they might. Well, maybe it's the same thing. I don't know.
Oh, it was fraud.
Yeah.
This guy was.
Okay, but yeah, we want to make sure that the information we have as far as your income matches what the IRS has. So we'll get their tax returns, but we order these transcripts. The transcript is what the IRS has received from the borrower. We just make sure everybody's on the same page as far as the income that this person has.
Right. So that was kind of like a pre-approval, and the reason I did that was because they claimed they had already been through 3 or 4 things.
Okay.
And, I think her name was Linnell or something like that.
Okay.
And she did it, but then it turned out he owed a lot of money, but he claimed he didn't owe it because that wasn't his stuff. But
Yeah. Yeah. So every once in a while you'll get these kind of interesting pickles where, something like that'll come up. But, we'll deal with it, as soon as you find out things like that, if there is a discrepancy between what we have and what the IRS has.
Well, I told his wife I just got my license, so I guess she got this wild idea. She'll never know.
Yeah.
We'll get a loan. She's brand new.
No good. No good. We squashed that in the bud real quick.
Well, I set her, or she was set up for pre-approval. They were set up for pre-approval.
Yeah.
Not happening.
Yeah. Not happening at all. Credit reports. So again, this includes the credit report. I'll touch base on this really quick. So when we pull credit reports, we pull information from all 3 bureaus, from TransUnion, Experian, and Equifax, and we use the number in the middle. So let's just say husband and wife. Okay. For the husband, we'll use his middle score, not the average, but the middle. The wife will use her middle. And then if you have more than one person on the loan, we use the lower of the 2 middle scores. Okay? Not the average, but again, we use the lower of the 2 middle scores. If you only have one person on there, you're just using their middle score, not the average. Okay? The reason why we do that is not all trade lines, so not all credit cards or auto loans or student loans or whatever, they don't all report to all 3 bureaus. So you can have some discrepancy in your different scores. And also, especially with Credit Karma and the different credit card apps, they'll tell you, hey, we'll let you know what your credit score is every week. Those scores are not always the same that we will see because they can use different scoring systems or modules. So again, we go off of what TransUnion, Experian, and Equifax state, but your Capital One credit card might use its own scoring system. So if they say, hey, I have a 700 score, look what my phone says, it's not uncommon for us to receive different information because it's a different system altogether. Okay. But that's the credit report. As far as tax service fee, so when you have an escrow account, this is a one-time fee that's made to make sure that their servicer of their loan always pays their property taxes on time. If you think about how many mortgages there are and how many property taxes these servicers, have to pay to all the different counties, that's like millions of dollars of property taxes, and this fee ensures that there are no penalties to a buyer. There aren't going to be any late fees, that their servicer is going to be paying all those property taxes on time. Okay, that's tax service fee. We talked about appraisals, and again, on a VA transaction, we do not, we waive that fee for our veterans, the same with their final inspection, about $150 or so. As far as our escrow fee, some of these fees can vary from title company to title company. So I've given you a printout for first title, but you might just compare some of the fees from different companies because some of them can vary somewhat. But your closing fee, basically, whenever your buyer and seller go to the table and sign all the documents, that closing fee is split half by a seller, half by a buyer. So I'm quoting about $150 or so for a buyer. Okay. As far as the owner's title insurance policy, we'll get to this chart in a little bit, but basically, depending on the size of the property that they're purchasing, the more expensive home that you have, the more expensive your title insurance is going to be. Okay, and that's then there's a mortgagee policy is basically an owner's policy. So with your title insurance, you have one policy that protects the owner and the amount of the loan. Okay, and that's going to vary based off of the size, the purchase price of your home. You have another 50, typically 50, but it'll vary from company to company, that insures the owner above and beyond their loan amount. So we've been saying $100,000 all morning, so let's stick with that. You start off with a $100,000 home and you have a $95,000 loan. That lender's policy is going to take care of that $95,000. Okay, after 15 years or so, as you pay down your loan, now your loan is at $60,000 or so. Well, that lender's policy is now protecting that $60,000, but now we have a lot more equity in the home that the buyer needs their protection on. That's what this owner's policy does. The lender policy, protects the outstanding loan amount. This additional, very small, very cheap owner's policy protects the owner for all of their equity. So it's not a required fee, but it definitely makes sense, and we have everybody get this owner's fee. But first title, we'll go over title insurance a little bit more thoroughly with you. As far as wire transfer and miscellaneous title fees, we quote about $125 or so. A title exam and a gap check. So basically what those are, the title company will examine the title to this home. They'll see how ownership has been transferred, and transferred over time. And they'll make sure that there are no clouds to that title, no issues with that title. So they might do that 2-3 weeks or so before closing once they get this request. And they've certified that there is clean title. But prior to closing, they do a gap check. So they are checking the gap between when they certified the abstract, that the title is clear, until a few days before closing, to make sure, that no liens, no additional liens or no other issues with title have been filed from the time they first certified this until right before closing. That has happened before. If you have a, let's just say 30, 45 day closing, we send our request to the title company. They're going to make sure everything with your title policy is in good shape. A week before closing, they might go and get a second mortgage, and now we have a lien tied to this property. That's going to be an issue. So that's the purpose of this gap check, to make sure, right before closing, there's no other issues or liens tied to this property. Okay, so there's fees for that. As far as recording fees, there's buyer's recording fees. There's state mortgage taxes, and if you want to hear, the nuts and the bolts of this, it's kind of boring information, but it's fees that the customer has to pay. Again, recording or certifying that this transfer of property took place. Then there's also recording fees for the mortgage, for the loan tied against the property. That's public record as well. We talked about our survey, generally about $150 or so. Elevation cert, this isn't too common, but like if you have a property that's in a flood zone, okay, one of the things that we do is we'll do a flood certification to see if your home is in a flood zone. So we've got our home. If it comes to be that you have a flood zone that goes through a portion of your property, but not your house, you don't have to pay for flood insurance. Okay? Think about this. If you have 5 acres or so, and your home is at the front, and grass and a few trees might be flooded, there's no real concern for that because it's not going to destroy your home. If your flood zone, if any part of your home is in your flood zone, then you would need to get an elevation certificate to figure out how expensive your flood insurance is going to be. For example, if I don't know, in this example right here, if we know that your home is 1 foot below that flood zone, your flood insurance is probably going to be much cheaper than if your home is 10 feet below that flood zone, meaning your home is, if there is that big flood, it's going to completely destroy your house. Okay? You won't come across this very often at all. Very few homes, within this area are in flood zones. But when you get your first one, you're going to learn a lot about it. But again, if y'all ever have questions, just ask us about it. But, your broker could give you some information, about, more about flood insurance, or we can as well. But it's provided through FEMA. But as far as flood insurance is concerned, they'd get the same premium from any insurance agent that they call, right? Your homeowner's insurance is going to be different if you look at Farmers, Allstate, USAA, but your flood insurance, because it's through FEMA, will be the same premium no matter what company you use. But if you have the second example right here, you're going to want to get that flood certification to figure out how expensive it's going to be, how bad, basically how bad you are in this flood zone. Does that make sense? Okay, and those can get pretty expensive, $400, maybe $500 or so, just to figure out how much your insurance is going to be. Okay? But again, it doesn't happen too often. Talking about termite inspection or your pest inspection, about $125 or so. For your home inspection, again, you guys will get contact information for different inspectors, and you'll use them over time. But those are going to vary from person to person. Also on the square footage of the home, if they have a pool, if they have different things like that. So, plan on several $100s for your home inspection. And then home warranties as well. There's several companies that have contact information just right back here. And as you go to your sales meetings, you'll meet these people, and they'll go over home warranty plans so that you can feel more comfortable, with those and going over those expenses with your buyers. Again, you don't need to remember any of these. Whenever we make our examples of financing for a customer that show what your interest rate is, how much your monthly payment, how much money you need to buy this home, we include this for them. So if you ever need to make your estimate for a buyer, you could always say, hey, Gordon, I don't know how to do any of this stuff. Can you give me an example of financing and just kind of walk me through it? And we do that for every customer that we work with, okay? So, yes, ma'am.
On the home warranty, home warranties, do those just cover appliance type things? Like the heating and air or dishwasher, garbage disposal?
Generally speaking, yes. I mean, there are different levels. And so I don't offer those, so I'm not gonna go over that information
right,
with you.
So that they're available if the people want them.
Yes, yeah, and a home warranty is not required to get a home, to get a home loan. If it's new construction, a lot of the, your appliances and things like that are going to be under warranty anyway. and you'll have a warranty from the builder, typically for the first year. If you have any issues, the builder will come back out and fix it. So new construction, you're probably not going to get a home warranty, but older homes, things like that, it might make sense to do that where, you could pay a $75 fee for them to come out and take a look at this and replace your appliance or your dishwasher or whatever the case might be, versus having to pay several $100s to get it replaced if you did not have a warranty. But yeah, so they're not required. For some people, it definitely makes good sense. And yeah, there's information right there with the contact information for the sales reps. So you might just give them a call or get with the broker, and one of the next sales meetings that you have at your real estate office. Frequently, they come by and they kind of talk about those, just so you can feel comfortable and know how to talk about it with your clients. Yeah, that's a good question. Any other questions kind of about the fees, about the loans, about how mortgage insurance works? Okay, so again, those are the main three that you hear about with your conventional, your FHA, and your VA. Now let's go over financing basics. We've talked about a lot of this already, but you guys are going to be basically mortgage professionals by the time we finish this class. You're all going to be so solid and so knowledgeable. So the nuts and the bolts for each of these types of loans, right? So FHA, we talked about this already. You have an upfront mortgage insurance premium plus a monthly payment, okay? Your minimum down payment is going to be 3.5% of the sales price. So you buy a $100,000 home, the minimum down payment on an FHA loan is $3,500, okay? And the down payment always has to be paid for by the buyer. You can get gift funds from a relative if you need to, but like whenever we talk about sellers paying expenses for a buyer, seller can only take care of closing costs, prepaids, inspections. If they've covered all of those expenses, let's just say their total closing costs, prepaids, and inspections were $5,000, and the seller says they were going to pay $6,000. Well, they can't take that other $1,000 and apply it towards their down payment. Okay, down payment must be, that's a borrower's minimum investment. So best case scenario, they can have all their closing costs and prepaids taken care of. They are still responsible for their down payment, but they can get down payment assistance programs. They can get gift funds from a relative, and we document all that, but it just can't be paid for by the seller. That makes sense? Okay, so 3.5%. Talk about credit scores. So the minimum credit score to be eligible for an FHA loan is 580, but it doesn't mean it's going to be easy to qualify, and it doesn't mean you're going to have a competitive interest rate. Okay, that's kind of the bare minimum to get in, but typically 620 or so is recommended. We do free credit counseling or credit advising with our customers. Whenever we initially meet, we'll take a look at your credit report, and if it's not where it needs to be, say if you don't qualify at all, or you qualify but just barely, you're going to be building a home for the next 6 months, we meet, with every customer, and we say, hey, this is where we're at right now. These are some things you can do over the next couple of months to make you eligible or to give you a better interest rate, try to increase your score. And if you guys ever have questions about that and want to sit down and just learn a little bit about credit, we can do that. But we'll do that a different day. But that's your minimums. And again, we talked about a gift or a grant, a gift from a family member or the down payment assistance program are definitely available to be used to cover that down payment. As far as the loan limits, we've seen that before, the 294, 514. As far as VA loans, again, if you are eligible for a VA loan, you've served in the military and you have your certificate of eligibility stating that you can get your VA loan, then most 9 out of 10 times that's definitely the way to go for a veteran. It offers 100% financing, so you don't have a down payment on a VA loan. Best case scenario, if you get a VA loan, there's no down payment. If your seller pays your closing cost and prepaids, were you in the military?
I'm in the military,
Okay.
And we did that, and I actually got money back.
Yeah. Okay, so we'll talk about that a little bit. You have 100% financing, so no down payment. If the seller pays all your closing costs and prepaids, there's no expenses to get in the home. But we talked about whenever you write up a contract, you have earnest money, okay? So you might have done $500 or $1,000 of earnest money. Well, if truly it costs you nothing to buy the house, but you've had a deposit, day of closing, you'd get back $1,000 because you've already paid that. Okay. And we don't charge an appraisal fee for VA. So, I mean, some companies do charge that where you might need to pay up front for your appraisal. So let's just say you pay $500 or $400 or whatever. Again, if the seller's paying that expense for you, the day of closing, you would get that money back. But again, we don't charge for appraisals. So the only funds that they might have to pay that they would then get back would be your earnest money. Or any home inspections, you know, if you're going to pay for those, since they're not required. But yeah, that happens very frequently. A lot of times sellers are highly inclined to take care of closing costs and prepaids when they're selling to a veteran. Okay. The loan amounts, we talked about the down payment, the funding fee. Again, there's many different ways to calculate this, and we'll do that for you. But if you are not 10% or more disabled, there is a one-time fee that we roll into the loan. If they want to pay cash for it, they definitely can, but most of the time they do not. Goes over the loan limit, $453,100, and then the minimum credit score, you know, being 600. For conventional loans, you know, we said this again, anywhere from 5 to 19.99% down is going to require mortgage insurance, and it's normally paid monthly. We talked about the loan limit, $453,100, and then the minimum credit score. So yes, you are eligible for a conventional loan if you have a 620 credit score, but we talked about that risk-based pricing on your mortgage insurance. So if you have a 620, yes, you would be eligible for a conventional loan. It might make more sense for you financially to do an FHA loan. So I can make that example and say, here's what you want. Financially, it might benefit you to look at a different option. Okay. And then jumbo loans, we talked about that. So any amount exceeding $453,100, depending on which investor you go with, some of them have a maximum loan limit of $850,000. Some will go up to $3 million, just kind of depending on what their credit score is, what their down payment is, some things like that. General rule of thumb, you need a 10% down payment, and their credit scores can vary, but generally about 680 or so. So you need a little bit more skin in the game and be a little bit more qualified to borrow these jumbo loans. Any questions about that?
And I'm just curious, like those houses in Gaillardia, they're more than $3 million. Do they have loans or are they paying cash?
A lot of them are paying cash. But again, if you have a $3 million home and you have at least a 10%, they're not doing 100% financing, on these homes. So if they do have a loan, they probably have a low loan to value. It's a $3 million home, but they might have a $1.5 million loan. So their loan to value is low. Generally speaking, if you're living in a $4 or $5 million home, a lot of those people might not need financing for it. But we've done, several loans for people in Gaillardia and Fairview Farms, Nichols Hills, Rose Creek. So we're very familiar with, multi-million-dollar transactions.
So they put down a large amount.
Correct. Yeah, the minimum would be 10% down. But again, a lot of the, if you're buying, like I said, $3-4 million, you've got some skin in the game. You're putting a good chunk of that down in cash and maybe paying the whole thing for cash or maybe just financing a portion of it. Yeah. Yeah, good question.
I was just curious, when it got bigger than that, what do people do?
Well,
not so much loans. I just wondered because it kind of looks like $3 million's it on the jumbo. So
there are some instances that could go over. That's kind of the general rule of thumb. But like in Oklahoma City, if you have a $3 million home, you're the top 0.2%, of our population. California, you could be a first-time home buyer buying a $300, maybe not three, but like one. You'd be a first-time home buyer buying a $1 million property. But as far as jumbo is concerned, those underwriters, across the nation, they would get the most elite people in Oklahoma City and these first-time home buyers in California. So, and they're all considered, they're all considered together. So, you know, if you're working with someone buying a $3 million home in Gaillardia, their expectation of you, of me, of this service is going to be very different than what a first-time home buyer in California expects. So that's why we like to just up front kind of set everybody's expectations. I understand that you make, you know, you might have 7 businesses and you have, you know, too much money in the bank and you have perfect credit. But to make this loan, I still have to get certain documentation from you. I still have to get all your tax returns. I still have to see your bank statements. So if you and I both kind of set those expectations of what is needed to do these jumbo loans, I like to manage expectations. You know what I mean?
Mhm.
And again, it's not saying that it, you know, it can't be done or anything like that. But there is a little bit more that is required to do some of these jumbo loans than just a regular FHA conventional loan.
Oh, I was just curious. I've got no one.
Very cool. Well, congratulations. So we covered that. We covered this. I guess let's keep on going. We're almost done here. Okay, so we've got our little. Again, I'm going to let First Title talk a little bit more about their title fees and things like that. But I gave you just a general cheat sheet for you to talk about title fees and quote those fees with a customer. Next, I've got a few cheat sheets that go over the HUD 184 Native American loans and the rural development loans. These aren't too common, so you won't be doing these as frequently as the others. So we don't need to spend as much time talking about these, but I just gave you kind of the nuts and the bolts for each of these types of financing. So our minimum credit score, you know, on the HUD 184 Native American loan, maximum loan amounts, you know, some of the documentation that we would need, so their Native American enrollment card and a CDIB, a Certificate of Degree of Indian Blood. It's got to be a federally recognized tribe. These are owner-occupied homes only, so no investment properties. An advantage of a Native American loan is that it has a lower down payment. So FHA, you'd have a 3.5% minimum down payment. Here we have 2.25%. So you get it, you know, get the home for a little bit lower down payment. 0.25% monthly mortgage insurance versus on an FHA loan, we're looking, you know, a little bit closer to 0.85. So that monthly mortgage insurance premium is going to be cheaper down payment. And then it also has that one-time fee that's financed into the loan, but it's also a little bit cheaper. So if you have a client who is, you know, part of a federally recognized Native American tribe, definitely we can make them an example of financing. It might be beneficial for them to get this Native American loan over a regular FHA loan. Okay. So again, some of the nuts and the bolts on that guy. We've got the rural development loan. So the main thing to know about rural development is these are geographically restricted. Okay, you can't get a rural development loan in Edmond, Oklahoma, or in Oklahoma City because that's not a rural area. If you ever have questions and you have a client looking at, you know, I want to see this home, this home, this home, you can always call me or Kathy and we'll let you know if it's eligible for rural development. But you can also go to their website. If you just Google USDA or rural development, you know, property eligibility, you can go to their website, type in the property address, and it'll let you know if that is eligible for USDA financing or not. And when I say USDA, that's the same thing as RD or rural development. It's the exact same. Those terms are interchangeable. But you guys, you know, you can just look at a map and kind of know, generally speaking, what part, you know, of your, you know, the city or the state would be eligible for this financing on a map, or you can look up an individual address to know if that's going to work or not. The benefit of rural development is it's 100% financing, so just like a VA loan. It does still have, you know, a monthly mortgage insurance. It does still have that one-time fee financed into the loan. But if you qualify for it, it can give you 100% financing, so you would not have a down payment. So for, you know, certain people, it's definitely beneficial. The next page, I gave you a cheat sheet of the different ways to calculate this VA funding fee. And it's broken up in a few different categories. Is this your first time using your VA entitlement, or is it a subsequent use? And then what type of veteran were you? Were you in, the regular military, one of the main branches, or were you in reserves or National Guard? Okay. Again, don't spend more than 2 seconds trying to figure this out. We can calculate this for you. And most of the time your veteran will know, if they're exempt from that fee, or, if they're regular military or reserves or all that fun stuff. The last thing about credit, we see this frequently. You might have customers who have gone through some major derogatory credit events, like a bankruptcy or a foreclosure or, things like that. And they say, well, hey, am I eligible for financing? It always asks us, but I just wanted to give y'all some information for the different types of loans that you do. So you'll see here, Fannie Mae, FHLMC, that's Freddie Mac, okay? Federal National Mortgage Association is Fannie Mae, and then FHLMC, that is Freddie Mac. We have FHA, VA, and then the USDA. You'll notice if you compare these FHA waiting periods to a Fannie Mae or a Freddie Mac waiting period, it's evident that FHA is much more lenient in terms of these major derogatory events. For example, if you had a Chapter 7 bankruptcy, that's the very top, the first item. If you want a Fannie Mae loan, you're going to have to wait 4 years from the time that bankruptcy was discharged. Not from the time you started the event, but from the time it was discharged until you're eligible for a new Fannie Mae loan. For FHA, it's only 2 years. So you might have perfect credit, and you might have the 20% down, but if it's only been 3 years since your bankruptcy was discharged, you would have to get an FHA loan. Even though conventional would make more sense for you, you would not be eligible for conventional, so you would have to do an FHA loan. Does that kind of make sense? Good. And then again, you can just kind of go down and just see some of these differences. But again, all these, kind of the start date has to do when that event was discharged or completed until you'd be eligible for your new loan. But again, if you ever have questions about that, feel free to give me a call and I'll visit with you or with the customer. The other thing that I want to talk about is down payment assistance. I didn't do this last class and I felt silly about it. So down payment assistance is something that we offer, and many of your customers might be interested in this or need this to get into a home. Most Americans, we can afford a monthly payment. They can afford their rent, they just can't save the money to afford a down payment to get into a home. So to solve that, there are down payment assistance programs. Some of them are geographically restricted. You need to be in this certain zip code or this certain part of town in this targeted area. Some of them are a certain census tract, but there are many programs available throughout the state of Oklahoma that if you qualify, they'd give you this assistance. And they're non-repayable grants. There are some that will, it'll be like a second mortgage, but the majority of the programs that we work with, if you qualify, they give you the money. It takes care of your down payment for you, so then you'd only have to worry about closing costs and prepaids. Just like we talked about with the VA loan, there's many times where someone qualifies for their down payment assistance, they get their closing costs and prepaids paid for by the seller, they only need $100 to buy a house. Not everybody qualifies for it. There's really 3 different criteria that the bond authorities look at to qualify for assistance. The first thing is a credit score. And you don't need to write this down, but I think I put it, I think I have it written for you. They look at a credit score of 640 or above. Each program is going to have its own income limits to make sure you don't make too much money to qualify. And we'd look that up for them depending on which program would make most sense for them. So credit score 640. We want to make sure you don't make too much money to qualify. And then the last thing is they look at your debt to income ratios. So debt to income, we'd look at the new house payment and everything that shows up on your credit report. So student loans, credit cards, auto loans, personal loans, all of your debt compared to the gross monthly income being used to qualify. Okay. They just want to make sure that you're basically not overwhelmed with debt or don't have too much debt that you can pay this mortgage back. So if you meet all those criteria, you get the down payment assistance, and then the day of closing, there's a check cut from this bond authority, so they cover your down payment for you. It's as easy as that. There's it's really not that complicated, and it's a great program, like I said, to help a lot of your first-time home buyers get into homes. They're not only intended for first-time home buyers, though. Yeah, with certain programs, you can actually own a rental home and move into this new home as your primary residence, and you can get down payment assistance for that. Okay. So if y'all ever have questions about down payment assistance, or any of this stuff, just let me know. But there's plenty of different ways to structure financing depending on the needs of your customer to get them into a home. And these are not the only ones. Again, we have renovation loans that we didn't talk about too much, but I don't want to overwhelm y'all with stuff. And about half of this is going to sink in, and half of it is definitely not, and that's perfectly fine. Just give us a call if you ever have a question. I think we said this earlier, but we got some little pens and notepads and things like that. One thing that I think is pretty beneficial, in there's a little card holder, so if you want to stick that to the back of your phone, you can keep all your business cards in there. So if you're ever out with clients, you can always have your contact information, or if you wanted to have one of our cards in there as well, just to say, hey, here's my number, I'm a realtor and I'm going to sell you a house or help you find a house. And then if you ever need a lender to speak to, here's Gordon or here's Kathy, they'd be happy to take care of you as well. But, yep, that's pretty much what I've got. So any questions for you guys?
Yeah, on the down payment assistance programs, is there a cap on how expensive the house can be for them to get assistance on it?
Yeah, so some of them have their loan limits. Most of the time, if you get down payment assistance, you're going to get an FHA loan because it kind of makes most sense that way. But there are conventional loans with down payment assistance as well. So your income limits can be higher on a conventional loan. Your debt ratios can be higher on a conventional loan. And obviously, the sales price or the purchase price of the home can be higher on a conventional loan. So, yes, that is available. Mm-hmm.
So those grants, are those pretty low income? Do they do that for lower income people to be able to get them into a house?
So they're intended for low to moderate income. And so I brought this, and I'm glad you asked because I actually brought this information. Some of them, the income limits will vary from county to county. And so on the low end, there's a few different things they look at. Some of them, they'll look at the size of your home. So if you just have 1 to 2 people in the home, it might be lower than if you have a family of 3 or more. So that's one thing they look at. On the low end, just generally speaking, if you make about $63,000 or more, you might make too much income to qualify. Some of that jumps up to about $73,000. Some programs go up to $80,000 and $95,000, and then other programs go up to on the conventional loans $140,000. So it can these are some of the questions that we'll ask them. Do you need down payment assistance? Okay, well, how much income do you make? So we'll be able to know if they need that. Okay, how can I structure this, or which program, or how can I do this to see if they still qualify for down payment assistance based off of how much money they make and where they're going to be and things like that.
Well, I think everybody'd want the one they didn't have to pay back.
Well, correct. But again, now some of those programs might have a higher interest rate. So it's kind of an offset. Not all of them. Like the best program, a lot of times, depending on your credit score, could be the same, or we've even seen instances where they had a lower interest rate taking this down payment assistance than if they paid for it themselves. But not everybody qualifies for that program. For that one specifically, it does have a little bit lower income limits. You do have to be a first-time home buyer. And when we say first time, you haven't owned a home in the last 3 years. So if you owned a home 5 years ago, you're still considered a first-time home buyer. But again, for that best program, it is a little bit more, not more difficult. There is more strict criteria to qualify. But if you don't qualify for that one, there are still down payment assistance programs available, but the interest rate might be higher than if you paid it for yourself. And for some people, It doesn't matter because they're willing to pay, 30, 50, 80, however much more a month to get that $6,000 or $7,000 of down payment to get them into the house. They can afford the monthly payment even with a higher rate. They just need the assistance to get into the home. But yeah, not all of them have a higher rate. Some of them do. But again, we make them several different examples. Hey, if you're considering down payment assistance, here's the program you would qualify for. Here's how much, here's how much your payment would be, and here's how much money you would need to purchase the home. Here's what it'd look like if you paid it yourself. And again, we do that break-even point. If you're going to pay X amount more to save however many thousand, you would need to live in this home for, however many months for this to make sense for you financially. But we go over all that. So if you guys ever want to see, hey, can you make me an example of, this DPA program and this, this just so you guys can learn about it, do that. That's no problem. It's easy. Good questions. Do y'all have any other questions?
Thank you.
Yeah. No, thank you guys. I know that's a lot, but I didn't do it after lunch because I knew you'd be really tired. And
I'll give that to Jared.
yeah.
What is he doing, bicep?
Yeah.